Today's market isn't confused, it's cautious, and the people holding it together aren't who you think. Good morning. This is the CRE360 Signal Daily Brief for November 18th, 2025. Let's break down how capital is actually moving today, because the signals underneath the market are shifting. The bond market is firmly defensive. The 10-year Treasury yield sits at 4.13%, a modest but telling drop of 1 to 2 basis points from last week, according to Reuters and CNBC. The driver isn't strength or weakness, it's uncertainty. With both inflation and jobs reports delayed by the government shutdown, investors are reacting to sentiment and central bank cues instead of hard numbers. MSCI reports Treasury futures volatility up 8% month-on-month, confirming a split market, some positioning for Fed easing, others frozen until real data returns. Zooming out, equity risk is shifting. Retail dip buying, once a stabilizing force, is now at its lowest point of 2025. Vanda Research and Bank of America report retail investors are net sellers for the first time since September. In their absence, institutions are supplying all net ETF inflows, yet volatility still jumped 11% month-over-month, per Reuters. For CRE, this means sharper moves in listed REITs, faster sentiment swings, and greater sensitivity to institutional positioning. The market's safety net is thinner than it appears. Speculation around Fed easing is creating some rate relief, but it's conditional. With the 10-year down from 4.30% last month, Mortgage News Daily shows 30-year fixed CRE loan rates at 6.40%, about 10 BPS lower month-over-month. Several national lenders have trimmed credit spreads by 5 to 8 basis points, but any upside surprise in the delayed inflation data can reverse gains instantly. Today's signature metric, 8%, the month-over-month rise in Treasury futures volatility. The market is flying without instruments. Today's conditions aren't about momentum. The modest dip in yields and CRE loan rates offers some breathing room, but the drivers remain fragile and tied to delayed data. With retail investors stepping back, volatility in equities increases. In this environment, rate relief is not risk relief. Operators who stay liquid, stress test scenarios, and remain ready to pivot will outperform. This cycle rewards readiness, not optimism. Looking ahead, we would watch for delayed inflation and jobs reports, as Fed commentary remains pivotal. A dovish tilt compresses spreads, a hawkish surprise tightens conditions. We expect volatility to persist with weaker retail participation. For the full analysis, visit CRE360.ai.